Inherited property basis. So inherited property, we talked about the property received from a gift. Now, unfortunately, we're talking about death, a little grim, but gifts kind of fun, nice, all that. Talking about inheritance from the estate of someone who's passed away. Let's talk about the alternate valuation date. What is that? How does that apply? Now, generally speaking, for the basis of inherited property, we use the fair market value of the date of the decedent's death. So if someone passes away, if they have a stock of $10,000, the basis to the recipient, so in the will it says it's going to go to the kid gets the stock, it's worth $10,000, that's the basis of the stock. Simple, very simple. However, we're going to introduce other rules, exceptions, lots of other points. Now, this is known as the step up or step down basis, as it adjusts the basis of the property to reflect the property's value at the time of the inheritance. Now, this applies to property acquired by bequest or inheritance. This is going to be seen in both cases. The alternate valuation date is an option available to the executor of an inherited estate when calculating the estate's value for federal estate tax purposes. What this is essentially saying it's giving you an extra option. So if you think the assets are going to go up or down in value, that's giving you flexibility in tax planning. Why is the IRS giving us, you're saying, well, it sounds like the IRS is giving us flexibility and a benefit for us to utilize here. Yeah, they are. They're throwing us a bone for once. So instead of using the date of death, we can also use this alternate valuation date to determine the basis, which again is super important for in the future when we, as the recipient of the inherited property, go and sell it. So that's where this fits in. That's why it's important. Just always remember, why are we doing what we're doing? There's a reason for it. You may think it's a stupid reason. You may think, why is this relevant? I really don't care about this, and that's totally fine. But if you understand why we're going through it, it'll definitely help in understanding everything. Now, we've got this alternate valuation date. It's an option available to the executor of an inherited estate. So just think of this person as kind of maybe like a lawyer, or the person dealing with the inheritance and the estate and the will and all of that, calculating the estate's value for federal tax purposes. If it's validly elected, the alternate valuation date allows the executor to use the fair market value of the estate's assets either on the date 6 months after the decedent's death or on the date the assets are distributed to the beneficiaries, whichever comes first. So first off, understanding that this is just a rule. It's just something you can do. So this is something you can do. And again, this is for tax planning purposes, and it can be advantageous in situations where the estate's value has decreased between the date of death and the alternate valuation date. So again, you want flexibility here. You generally want the basis to be higher for individuals receiving this because then when they eventually sell it, they don't have to pay as much tax on that. So again, flexibility in tax planning. Now, when the executor elects to use the alternate valuation date, the basis of an inherited asset is determined based on the fair market value at the earlier of the two dates, again, the distribution date or 6 months after the decedent's death. This adjusted basis is going to be essential for tax purposes, as we've mentioned, as it can be used to calculate that capital gain or loss for the beneficiaries when they eventually sell the inherited asset. Now, for example, let's say if the value of an asset declines within the 6-month period following the decedent's death, the beneficiary, the person receiving its basis in the asset, would be lower, potentially reducing the capital gains tax liability upon the sale of the asset. However, the executor must carefully weigh the potential benefits and drawbacks. Again, dealing with, there may be other factors as well, but all we care about are the tax implications, which pretty much is just basis. There may be legal repercussions or just logistical things, but we don't care about that. We're caring about taxes on this exam, as it does apply to all assets in the estate and may result in increased estate taxes if the overall estate value has increased during the same period. So again, we're thinking that generally we want a higher basis, but we also want lower values on certain assets because you may have to pay tax on those. And we do have a whole lesson on inheritance as well, but as we're going through basis, we're going to mention everything throughout the exam you're going to need to know that has to deal with basis. Here's an example. We've got a scenario where the executor of a decedent's estate elects the alternate valuation date and none of the property included in the gross estate has been sold or distributed. The estate assets must be valued as of 6 months after the decedent's death. Now, the alternate valuation date is chosen as the earlier of the date of distribution or 6 months after the date of death. Now, since no property has been sold or distributed in this case, the appropriate valuation date is 6 months after the decedent's death. You can see a question that deals a lot more with the numbers and the calculations, and we will get to that eventually. But first step is just what is the proper date? First step, step one is what is the proper date? We have to choose between the 6 months from the date of death or the distribution date. So just practice that, understand that that is the first step. Then we will move on to dealing with calculations and understanding what the value of these assets are when they are distributed. All right, we're going to see some examples here. Inherited property basis. Now this is going to be a step up basis example. We got example 1 here. What is the original basis to the person who died? That was $50,000. Let's call it a car. It was a $50,000 car. What is the fair market value at the date of death? It's $80,000. Let's say it's a collectible car. It's an old car, so it's going to go up in value. In this case, the beneficiary's basis in the inherited property would be the fair market value at the date of death, which is $80,000, because on the previous slide we talked about, we're going to use the the date of death as our date we're going to value everything at, which is a step up from the decedent's original basis of $50,000. So it looks good there. But the reason why we may not want to do that also is we'll talk about estate taxes in that lesson. On estate taxes, you may have to pay tax on this property from the estate's perspective if the value of the asset's gone up, in which case there would be less assets to distribute among everyone. Again, planning, tax planning, all that stuff, just factors to consider. So the recipient's going to say, oh, wonderful, I have a higher basis, so I have to pay less tax on this when I eventually sell it. But overall, there may be less assets to distribute from the dead person's estate because the value went up and you have to pay more tax on that. So just different considerations. Here's an example of a step-down basis. Well, the original basis was $100,000. Let's say this was a piece of land, and the fair market value actually decreased, so now it's only worth $70,000. Maybe it was in an area prone to flooding, so the fair market value of the land went down. Now here, the beneficiary's basis in the inherited property would be the fair market value at the date of death, which is $70,000. That's a step down. Step up, it goes up. Step down, it goes down. Pretty straightforward there. Now, in some cases, the executor of an estate may choose to use an alternate valuation date for the inherited property. This option is available if its use lowers the entire gross estate, so everything. You can't just say, oh, I want this one asset, this truck, this ring, this piece of land, this building. No, it's all of the assets in the estate have to be affected by this. So the entire gross estate and estate tax, even though individual assets may go up or down, so not every asset's probably going to go up, not every asset's going to go down, some will go up, some will go down during the period. The alternate valuation date is the earlier of 6 months after the decedent's death or the date of the distribution or sale of the property. Memorize that. Again, sentences like these, I'm going to repeat over and over, and if you don't memorize them, I will pull my hair out. Now here, we're going to see example 3. This is using the alternate valuation date, and we've got a decreased value. So the decedent's original basis was $50,000. Let's call this a building. So it's a little building, $50,000 building. Fair market value, it actually went up to $80,000. And the fair market value at the alternate valuation date, which is 6 months later, is $75,000. Now, in this scenario, if the alternate valuation date were validly elected and it lowered the entire gross estate and estate tax, the beneficiary's basis in the inherited property would actually be 75 instead of 80. Again, validly elected, we saw a couple slides ago how you need to choose the earlier. So you got to determine, is that validly elected? Is that a date we can use? Example 4, we've got an increased value, kind of same thing. We've got the original basis, we've got the fair market value at the date of death, and then we've got a $75,000 value, fair market value at the alternate valuation date, which is 6 months later. Now, in this case, if the alternate valuation date were validly elected and it lowered the entire gross estate and estate tax, the beneficiary's basis in the inherited property would be $75,000 instead of $70,000. Now, in summary here, the basis of inherited property is typically adjusted to the fair market value at the date of the decedent's death, or if validly elected, remembering that, the fair market value at the alternate valuation date. Now, this allows for a step up or step down in basis, which can have significant tax implications for the beneficiary when they eventually sell or dispose of the property. Again, that's the whole point of basis, is to establish what it is. Again, when we sell the asset, eventually it's selling price minus basis. That's how you determine the taxable gain or loss. The alternate valuation date can only be used if its application results in a decrease in the gross estate and estate tax, even if the value of individual assets within the estate increase or decrease during the 6-month period following the decedent's death. Sounds good to me. Sounds good to you. Let's keep moving along. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material. We'll do it together. Tap into the power of cpa.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.